Benny, for a little bit more on tips, we are joined right now by Kenneth Volpert. He manages $21 billion in an inflation-protected securities fund at Vanguard. He is joining us live from his trading floor in Valley Forge, Pennsylvania. Ken, glad to have you with us. Tips are rising compared to Treasuries. Are they still good value?
You know, so much of the rise that we've seen so far this year is really an unwind of the underperformance that happened in the fourth quarter. It was really this deflationary scare that happened in the fourth quarter, and that got unwound over the first 5 to 6 months of this year. So we had break-even inflation. The difference between a 10-year real nominal Treasury and a 10-year TIP went from about 2% to 0 in the fourth quarter. Really, in December, it kind of hit 0, and that's gone back up towards 2%. So it's really just a reversal of the underperformance in TIPS in the fourth quarter.
Now,
so that was phase one. So now we're looking at really phase two of the TIP performance rally, which is really going to be related. It's a longer-term phase, right? It's going to probably take a year or two to play out, and it's really going to be the economy recovering, bank lending picking up, so that the reserves that have been injected, the trillions of dollars that have been injected in the banking system, kind of play out into demand in the real economy that ultimately will result in higher inflation. And the TIPS market is going to anticipate that and price that in over the course of the next year or two.
Let's talk about the break-even spread, because you just made a reference to it, hanging out at around 2%. But in one of your research notes, you say basis points we could go over 300, so over 3%?
Yeah, we could get over 3% in the break-even during this second phase, right? This is the period when, you know, the economy starts recovering, bank lending starts picking up again, and then a lot of the stimulus that's been put into the banking system needs to be taken out. And that's going to be a challenge, I think, for the Fed and for the government policymakers to take that out at the very time that the economy is growing, but it's growing very slowly.
And a little historical note here. I mean, the record, right, for this break-even spread is 333, and that was back March 1997, right, with the tech stock boom?
Right. Yeah. Well, part of it also was when TIPS were fairly new at that point, and so there was a liquidity premium that you were getting as well that was causing the TIPS to be a little bit distorted, I think, in terms of the pricing.
We have the FOMC meeting this week. Of course, everybody is keyed into the quantitative easing language, whether or not the Fed is going to keep going with some of its programs, MBS coming to mind. How do you think we're likely to see these concerns on either side of the fence play out in the TIPS market?
Well, I think probably what the Fed is going to do is keep the quantitative easing language and maybe the size in there, but not be as clear about whether it's going to be Treasuries versus mortgage-backed securities. I think it's kind of caught in a little bit of a bind there by specifying the precise dollar amounts that they were looking to buy, and it takes away some of their flexibility. Ultimately, the banks need to start lending again to really get a lot of the stimulus to actually play out and help the real economy. And so they're probably going to continue to inject these reserves through buying these securities until such time as the banks start lending that money out to small businesses and to consumers and really get the economy chugging along again. So
you don't think the Fed slows down at all, kind of looking at what the bond vigilantes have done? In other words, that their plan seems to be backfiring. You think the Fed just goes straight ahead?
I think the Fed, until such time as the banks start lending again, the Fed probably continues to buy, but in the language probably gives itself some flexibility around how quickly it gets there and what mix of assets it buys.
Quick thought here before we leave. Do you think that we need to see realized inflation in the market as far as the TIPS trade go? Sorry, there's only about 20 seconds, Ken.
No. Real inflation, the actual current inflation, is a small component of the return. So much of the return of TIPS is really based on expected future inflation, because that's the difference between a TIP security and a nominal conventional Treasury security. And that's where the most of the return comes from, is the move in those rates.
Ken, thanks very much.
You're welcome.
Ken Volpert there from the Vanguard Group.